As I listen to the media and I try to follow the war in Iran, the first thing I think about is there's a narrative trying to be played out that the President of the United States would like all of us to buy into. The question is, why does President Trump try so desperately to push the price of crude oil lower and get the Strait of Hormuz open? Well, I can tell you why. It's very simple. The incredible economic narrative that President Trump wants this country to have and that he's desperately trying to get in place is that we're the strongest, most booming economy in the history of modern times. The problem with that factor is we need interest rates really low. The problem with that is we need energy to be really low so interest rates stay low. And when you have inflation and you have higher crude oil price and energy prices, it drives up the cost of capital. It makes people not want to use the normal consumption using fossil fuels, so you have demand destruction. You now have other countries who are basically not aligned with, they're not allies of, or they're in fact enemies of the United States. We fill their coffers with a lot of money when oil prices go higher. Russia, Iran, Iraq, other countries that we've had conflicts with or we're definitely not aligned with, they make a lot of money when the price of oil goes up. It's really hard to put other countries and other economies at bay and limit their global exposure when they get billions upon billions of dollars when the price of crude oil and natural gas and LNG goes up. So the president made it very clear. He has a massive agenda to create one of the largest economies in the history of the modern world. And it's based on low interest rates, it's based on low energy costs, and it's based on a presence globally that says the United States is going to come first. And I don't disagree with what his efforts are, I just don't think it's going to happen. And today, I believe the Strait of Hormuz was a misguided judgment call on what could really be done trying to put Iran in its place. And the fact is, it's a hornet's nest. It's a hornet's nest that now has a lot of sticky fingers to it. Between all the Republican Guard and all their allies, such as Hamas and the Houthis and all those that are across the globe that are in favor of and support what Iran does and represents with the Republican Guard, we're now faced with a very sticky issue. Can we open up the Strait of Hormuz, get away and save the intentions that we went into that war in the first place, which is denuclearize Iran? And what does that look like in terms of reality and timing? Well, the fact of the matter is we're not going to see any type of a resolve in terms of crude oil supply coming out of the Strait for a very, very long time. They don't need a nuclear weapon. They don't need a ballistic missile. They need about a $25,000 drone to fly over a pipeline that Saudi builds or UAE builds or somebody else builds and make sure it's dismantled day after day after day after day. And when you cause that disruption on the water, on land, at the terminals, at the ports, bombing the Aframax, bombing the waterborne vessels, what you've done is you've created a disruption in global supply and a lack of assurance. When I think about why we need oil prices to be lower and what the president's trying to do, we have a lot of debt. The United States is carrying about $40 trillion in debt, about $1.2 trillion a year in interest payments alone. If we see the 30-year Treasury keep going up on yield, it's a clear indication that those that are buying the U.S. debt are saying, we need to be paid a higher interest rate. Your debt's becoming more precarious. Your interest rates are not coming down. Your commercial real estate is not going to perform very well as a result of higher interest rates. The several billion dollars, if not over $1.2 trillion in commercial debt cannot be refinanced. Your mortgages and your residential market is going to take a big hit. Your stock market, driven by AI and technology, is going to be definitely affected because they're going to be massive consumers of fossil fuel. And if they have to pay more, maybe it underpins and dismantles the financial model that these AI and data centers had to have in terms of cheap fossil fuel for them to successfully launch those new data centers and those AI platforms. See, the president has to have a narrative that we have cheap oil and gas. He has to have it because that's what drives his success of his financial plan for this country. But if you take a look at where we're at, that narrative's coming unwound over the last 120 days. And I don't believe, not trying to undermine or support what we're doing in our war effort, but from a pure financial perspective, I don't see he's going to be successful with this intention. I fully believe we're looking at oil prices north of $95 a barrel by the end of December this year. I fully believe, depending on the severity of the supply disruption, you could easily see well over $100 a barrel in the next 45 days. In fact, some of my numbers that I've run just based on supply and demand, one simple guy looking at the logistical and the fundamental analysis that I've done suggests we could see over $150 a barrel by the end of the year, and that is not unreasonable because it actually could be much higher. Now, does that sound like rhetoric or panic or scare? No, it doesn't. What it sounds like is we have a range, in my view, of somewhere at the bottom end, about $65 a barrel, if everything solves itself, and then it works its way back up. Very short time frame down at $65 a barrel, if it ever gets there. Long term, on average, we're back to 2010, 11, and 12, where oil got over $95 a barrel and stayed there, and it didn't come down for about 4 or 5 years. Likely that's the case we're in, except one key factor. That platform, that basement price, isn't $45, $55, $85 a barrel. We're talking that platform could be north of $100 a barrel for the next 3 to 4 years, purely because the cost of capital, the demand on oil, the lack of supply, the disruption of 1.5 billion barrels that's been lost in supply since the war started and continues today as the Strait of Hormuz blockade is in place. Look, folks, those wells were shut in. They said if they don't open up in 60 days, it does wellbore damage. They can't fill the tanks. They can't get the crude oil out. Aframaxes are not coming back in the Strait. You have a complete disruption of 12 to 20 million barrels a day. That is cataclysmic in terms of global supply and demand. So who's going to win? Who's going to win the oil pricing war? Let me tell you who's going to win. The wealthiest countries are going to win because they can afford to buy that Aframax on the open water at an open bid for $150 a barrel because their economy has to have it. The less fortunate, less economic countries are going to say, we can't afford that diesel. We can't afford that crude oil. We don't have the refinery. And so what's going to happen is their economies are going to get dismantled. I can assure you China's been pulling oil out of their 1.2 billion barrels of reserves for one reason. They're trying carefully to use what they already have in storage to take the pressure off supply. By not importing, by not buying oil in the open market, it leaves excess oil temporarily, which makes the price of oil subdued, which is what happened the last 3 weeks. But China's going to figure out we can't afford to use our savings account of crude oil and storage to just help the oil price go lower. Why? Because we're one of the leading economies in the world. We can withstand oil prices at $150 a barrel. We cannot be outbid. We won't be outbid. We have 1.5 billion people to feed and take care of, and we have exportation that's the lifeblood of our economy. We'll buy oil at whatever price, but that's exactly why they stored 1.2 billion barrels of oil, and that's why they have about 2 billion barrels of oil in total storage. Look, U.S. debt is our Achilles heel. We have a $40 trillion debt, and it's growing by the day and by the hour and by the second. We have to look at $1 trillion in interest only. If our bonds and our yield goes up to 5.5%, 6%, 6.5%, what you're looking at now is inflation, and it's going to be rapid or hyperinflation. You take hyperinflation combined with a bidding war for open barrels, physical barrels of oil across the globe, with 10 to 15 million barrels short, you can have all the demand destruction you want. The supply destruction is going to be 3 to 4x demand destruction. That is a perfect scenario for an economic storm of crude oil prices over $150 a barrel. Look, I'm not the end-all be-all, but I can tell you this. If I'm playing the crude oil market, I'm going long, and I'm going long north of $95 a barrel for the next 6 to 12 months. In fact, if I really want to take some positions, I might go long on $125 to $150 a barrel sometime in the next 90 days. Thanks for listening.